Hello, everyone. Today on the final bar, it's Wednesday, August 3rd. We're talking with Louis Llanes of Wealthnet Investments. We'll get his take on the big picture environment. Decent update today for stocks, certainly more of a risk-on feel with the FANG sectors, technology, consumer discretionary communication services leading the way higher. All three of those sectors up over 2% through the course of the trading day. This is a bit of a diversion, a bit of a change from the choppy sideways feel so far this week. Ladies and gentlemen, this is the final bar. Hey, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in these markets using the power of stock charts, using data visualization techniques, the best practices of technical analysis, some of the behavioral finance concepts that we review occasionally, all bringing those to the attention of the markets and focus on what information we can draw out of the markets themselves. The whole discipline of technical analysis is built on the concept that the markets have information, right? By analyzing price data, analyzing volume, analyzing price momentum and trend, we can understand or get inside the head of other investors, understand those changes in investor psychology. John Murphy, Martin Pring, people that we are very fortunate to feature as StockCharts contributors and as strategists, have shared those lessons through their books and through their continued writings for StockCharts.com. And just for 30 minutes every weekday, we try to apply those real time to the market environment as we see it. We're going to get to a market recap here in a few moments. I did want to let you know what's coming up. I'm excited to talk to Louis Llanes here in a few moments. He's one of my favorite guests, always a bit of a different perspective from the chart-oriented work that we often do on the show. Next week, we have two really good guests for you lined up. On Tuesday, the 9th, we have Ari Wald from Oppenheimer in New York. On Wednesday, JC O'Hara from MKM Partners is going to join us. Also, a couple other specials this week to highlight for you. Today, we're airing our latest special event, our mid-year market outlook called Charting the Second Half. We had 4 contributors, myself and 3 others, all answering a series of questions about the market environment. Where do we see the S&P between now and year end? What sector themes do we think are going to be important? What about interest rates? What about the dollar? And hopefully will help you make sense of not just today, but the overall environment. Technical analysis is about the short-term flickering ticks, but it's much more about the long-term structural changes and how these markets are evolving. So check that one out for sure if you haven't seen it yet. Also, our latest episode of The Pitch is coming up this Friday. I'll be moderating a conversation with 3 guest commentators, each pitching you 5 stock or ETF ideas. That's coming up on Friday the 5th. And all of those, if you miss them, are on demand at all times at StockChartsTV.com. Let's continue on today's show with our market recap. Let's look at what's happened today. As I mentioned in the introduction, nice rally move today, differing quite a bit from what we saw Monday and Tuesday. Monday and Tuesday of this week, sort of choppy sideways. Last week was all about risk on in terms of the short-term rally mode. The last couple of days have been sort of a stalling out, right? Sort of the uptrend is now over. We're now digesting it. And what's next? Today, an argument for the bull case, right? With the S&P moving higher, finishing the day just below 4160, settling in around 4155. That's up 1.5% from yesterday's close. The NASDAQ doing even better with the NASDAQ 100 up 2.7%. NASDAQ composite, obviously, as well. Mid caps and small caps both up about 0.8, 0.9%, so less than the S&P, but still having a decent update. And the VIX, which had been bouncing higher a little bit, pulling back down actually just below 22 at today's close. Kind of a weird, interesting day for treasuries, for the interest rate side of things. If you're following the charts today, rates moving higher in the morning, and then basically going into the afternoon, coming back and giving up all of the upside that we saw earlier in the day. So bonds at the end moving a bit higher. Long bond yields came off a little bit. 10-year yields bouncing a little bit higher, and the dollar index up about 0.3% using the UUP, which is a bullish dollar ETF. Gold and silver having a decent day. So remember, don't ever think just because stocks do one thing, gold should or could do something else. These are all different variables, all interrelated in a lot of more complex ways than we probably want to think about. We love to think of very simplistic relationships. This moves up, so that should move down. At the end of the day, there are a lot of moving parts and a lot of competing narratives that net things out. This is why looking at the charts can be so valuable and focusing on the markets themselves and what they are telling us. Gold moving higher today, about 0.25%. Silver prices moving a bit higher as well. Energy off, and the energy sector was the worst performer by far today out of the 11 S&P sectors. Bit more risk-on feel to cryptocurrencies as well. Bitcoin and Ether up over 1%. Bitcoin up around 23,500, actually just below there today. This is up higher. Getting above 23,000 was pretty significant. The question for these cryptocurrencies is, can they sustain any of these rallies? They have these nice bounces, but then they fizzle out very quickly. That's been the story in recent weeks. So it'd be interesting to see if you can mount more of a sustained advance on any of those cryptocurrencies. You know, looking at a chart of the S&P 500, we're in sort of this key range, this blue shaded area. And it's funny, a lot of my conversations recently have been one of two sort of general themes. Either we are at the end of a bear market rally. My conversation yesterday with Jonathan Krinsky was sort of in that camp. We've had a pretty good run. We've gotten up to the point where bear market rallies usually stall out. The current move looks a lot like what we saw at the end of March, getting above the 50-day, testing the previous swing high and just barely getting above it before struggling. Momentum with the RSI getting above 60, showing some, nice buying power over a couple of weeks for a sustained rally. But that was it, right? That was the end of the move before we went on to make new lows. And the challenge or the concern to the bull market case along, with that thesis is that we've had the run, right? Impressive run, no doubt. A lot of individual stocks have done very well, but the S&P is now up into that range. So this blue shaded area, I would argue, is pretty important. Can we get above 4,200 through the course of this week? That would all of a sudden, I think, change the way you could probably describe this market. I know I will force myself to change from sort of the bear market rally thesis that we've been talking about on this show. The other camp is the bottom is in, the markets are ripping to the upside. Tom Bowley has done a great job promoting this sort of thesis. Names like Tesla that he follows, I know, are just doing beautifully, and I totally get it. Larry Williams just did a special, I think we aired on Monday. And if you missed that, go to stockchartstv.com or on our YouTube channel, really laid out the thesis for a sustained bull move from here. The seasonality doesn't agree with that. That's what concerns me about that thesis. Besides the fact that we've run up, we're in the seasonally weaker part of the year. And more often than not, you sort of have the summer doldrums going into some sort of bottom in the fall. That's like the base case for an average year. This year can be not average. And that's why we don't just base it on cyclical patterns. Is why we look at the evidence that the charts themselves provide. So impressive run to here. I think the big question mark, do we have enough left to break above those highs and move to the upside? I'll look very briefly here at some of the other breadth measures. We haven't checked in on these in a little while. I just wanted to look at where we're at. So when we're talking about the markets here, sorry, I remember I was dialing back. I wonder why this chart looks so weird. It's because I dialed it back. I was looking at a historical period for my clients, and that's why it looked a little off. There we go. This looks a little better. So this is looking at the S&P 500 over the last year on a closing basis. Here you can see we're approaching the closing high from early June, which is around 4175, we'll call it. Below there, we have the advanced decline line for the New York Stock Exchange, for the S&P, for the mid-cap index, for the small-cap index. We can see that the small-cap AD line has already gotten above its June high. The mid-cap AD line, not quite yet, although today, this isn't updated for today's close just yet. I would not be surprised if the mid-cap AD line actually gets to a new swing high as of today's close, given the strength we saw. I don't know. It depends, because mid-caps were below the S&P and the NASDAQ. So I don't know if that's actually going to necessarily be the case. But the most concerning is at the top end of the chart here, particularly the New York Stock Exchange AD line, not confirming a breakout yet. So I think along with the S&P getting above 4,200, the AD line's also making a new high, getting above their June highs. I think would be important to a bullish thesis here, because that tells you it's not just the mega cap stocks, right? Charts like Apple look pretty decent, and they've had these nice runs back above the 200-day, well above 150. which was resistance from June, pulled back and retested it, and now rolling over to the upside. That's a pretty impressive chart. Certainly from a technical perspective, opens the way to retest the previous highs around 180 on our using our adjusted data. I think that's totally reasonable from a technical perspective. However, if it's just a small number of names doing that, that's not going to be enough. You need broader advances that are driven by broader participation, and that means the 80 lines need to get above their June highs as well. That's what I'd be looking for there. Interesting to see that about 75% of the S&P 500 members are above their 50-day moving average. That's that bottom series in green. In mid-June, it was literally 5%, maybe a little less, of the S&P above their 50 days. So literally 95% of the index below the 50-day moving average. And now 70% of the S&P members were below and now are above, right? So made a huge pivot from below the 50-day to above the 50-day. This is what the S&P did in mid-July, getting back above its 50-day moving average. The fact that 70% of the index has done that is pretty impressive. And what's different now than what we saw in March is we had not been so bombed out before the rally. These last couple rallies, November, January, March, even going back to last August, which was a pretty major top during, sort of the end of that big swing before we had a brief pullback to 4,300. Every one of those times, just above 70% of the S&P made it above their 50-day before we reverted back to the downside. So what's interesting to me would be a sustained move above here, right? Can we hold 70%? Because that's been the big difference here, is that we've gotten up just above 70%, then we've rolled over. So that is why it's very easy to label what we've seen so far as a bear market rally, because it's sort of gotten to that same point. Things are different if we can get above the previous swing high, get above 4,200 and hold that. Get this indicator to continue higher or just hold 70%, which tells you most stocks remain in a bullish phase. That's what I'd be looking for right about now. We need to wrap this market recap. We'll take a quick break. We'll be back with today's guest, Louis Llanes. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close as we break down these markets using the best practices of technical analysis and market analysis. A couple quick announcements before we get to today's guest, Louis Llanes. First off, we welcome your questions. We'll do another mailbag segment on Friday's show. We had a great time yesterday on Tuesday's show answering some of your questions. Keep them coming. Email is the best way to get your questions to us. thefinalbar@stockcharts.com. is our email. You can also get us on Twitter at FinalBarSCTV or on our YouTube channel. Just put a comment below the video you're watching. We'll gather all those questions and hope to answer one of yours live on the air on our next show coming up on our next mailbag coming up on Friday's show. Also go to StockChartsTV.com. That is our on-demand platform. There's so much great content for you. I mentioned Larry Williams' Market Outlook special from Monday. Martin Pring did a mid-year market outlook a couple of weeks ago. We have our latest episode of The Pitch, our mid-year market outlook called Charting the Second Half. All of that for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Louis Llanes. Louis has been a frequent guest on the show, and we so appreciate it. He's the founder of Wealthnet Investments, coming to us from Colorado. Louis, great to see you. Welcome back.
I'm glad to be here. How are you?
So we have a lot going on. In 5 minutes, we have a lot of things we could cover, and I appreciate you giving us a couple charts to make sense of things. Obviously, Fed meeting last week, big week, and a ton of earnings. Talk us through your charts and what you're seeing now.
So really, I think the biggest risk that we have right now is that the Fed has to tighten a lot more than we expect. And what I want to do is build a very simple case as to why that may be the case, why that may happen. What this chart shows is the effective federal funds rate versus the inflation rate. So when that federal funds rate is above the inflation rate, the Fed is tighter, and when it's below, the Fed is looser. And that's just something that we've seen throughout history. This chart goes back to 1954, and it shows all the recessions with the shaded line. And one of the things that I wanted to point out is that normally the federal funds rate, as you can see throughout history, is above the inflation rate. And we had some times now where we've gone below that and we've gotten excessively loose. And we really started getting loose. If you look down in around the Obama administration area, that was like unprecedented looseness. And that this is just a simplified way to look at this. And then we actually, when Trump came into office, we started tightening. We were trying to kind of reverse our sins, if you will. And then the pandemic hit, and then the monetary aggregates exploded. Okay, we all kind of know this, okay? But look at that inflation line. Look at the spread, 906 versus 2.32. That is a huge spread. Now look back all the way through time. You don't see that very often. So what this chart is really just showing is that we've had extended periods of monetary looseness. It's not just supply chain issues that we're dealing with here. So on the next chart, I'm going to explain something about employment, because that seems to be what a lot of people are talking about.
Yeah, it's so interesting. It feels like so many of us have focused on the rise in rates in the short term. But if you look, we still are very much in the easy money era, I guess, if you look at the long-term data. Go through your unemployment chart if you could.
Yeah, this chart just shows the unemployment rate versus the inflation rate, same time period. And we've been hearing a lot of talk that somehow this is different now. We've had 2 negative quarters of GDP, and the rationale has been mostly related to employment, that employment's strong, so therefore we don't have a recession. But if you see those arrows there that I showed there, that shows that in almost every single recession, unemployment rate is low. As you're going into it, it's a lagging indicator. And you know, I learned that in Economics 101 when I was like a junior in college. So this is something that we need to look at the data and not listen to talking heads. That's as an investor, that's kind of how I like to operate. So the assumption that I'm making there is that we're seeing layoffs, right? We're seeing lots of layoffs that are happening in real time. So I'm not saying that it's an inevitable thing that inflation is just going to keep going up, because the market right now is pricing that inflation is probably going to come down. We're not actually pricing in continued inflation, but there is definitely a risk that inflation continues. So for that reason, the probabilities, I believe, are greater than 50% that we're not at the low right now.
Very, very interesting. So, of course, the $1 million question, how do we play it? How are you approaching this from an investment standpoint, given all that you said so far?
So the thing is that you have to keep in mind is that we are quantitative in nature and we're fundamental in nature. So when we're looking at the fundamentals, the valuations don't look good, but the sentiment and the technicals have been improving. So therefore, our exposure has gotten more into the market. So this little table on the left shows that we're now we're about 56% exposed into equities right now in our equity models. So in those portfolios, most of that is in the growth area, the kind of value quality type companies. Those technicals have not improved as much. So really the way that we deal with this is to do some hedging around key technical points. And it looks like we're entering a key technical point that we could hedge some of our exposure, but not get out of the market, because as I always say, picking bottoms is very difficult. It's better to move gradual.
Oh, there's so many little nuggets of investment wisdom just in those last couple of sentences, Louis. I love it. We have about a minute left. You know, I'd love for you to think, and again, we've talked before about how you approach things really from more of a quantitative approach, which I really appreciate. How do you deal with this sort of environment where it's been a clear bear market phase for 2022? I think a lot of investors have sort of come to terms with that. But then all of a sudden you have about 3 to 4 weeks where it just completely changes. How do you, when you're approaching your own portfolio or when you're dealing with clients, how do you help them get through that disconnect where you have a long-term trend doing one thing, but all of a sudden the short-term completely changes? How do you balance those timeframes in your approach?
So we basically will adjust our exposures. If the fundamentals setups are there, and we will listen to what the market says and increase exposure. And so we never go completely in or completely out. And then we'll hedge exposures at key levels. Like right now, we're coming up to the resistance points that you point out. Everybody can see this resistance point, but there's one key thing that we've learned by doing quantitative analysis. You don't want to short these things if you're going to hedge as it's moving up. A lot of people do that. We like to see it move up and then stop our way in if it fails. Because if it doesn't fail, a lot of times what will happen, and quantitatively the numbers work better if you wait for the actual reversal to happen. You do get more slippage that way, but you also get a higher probability that you're right. So there's always a trade-off in the markets, but I would not fully hedge this exposure out. So having zero in the market right now doesn't make sense.
Yeah. That's a great way to think of it. And I really appreciate your focus on the evidence and promoting that to all of our viewers. Listen, it's great to see you. Thanks again for coming on the show today. Thanks for sharing some charts. Stay safe there in Colorado. We'll talk to you again soon, all right?
Thanks a lot, Dave.
That's Louis Llanes. Louis is the founder of Wealthnet Investments, coming to us from Colorado. He always does such a great job of boiling down a very thoughtful, deliberate, beautifully detailed process into a couple nuggets of insights. But I love his comment at the end about how to approach this sort of environment. I get a lot of questions really driven by the short-term action of the markets. And what I always try to remind people is make short-term decisions with short-term data, make long-term decisions with long-term data. So make sure that you're focused on the appropriate time frame for the type of analysis, for the investment horizons, for the goals that you are trying to accomplish. And that's going to be a good way to approach things. Great take there, as always, from Louis Llanes. Let's continue on our analysis on this show with our next segment. The bottom line. The bottom line is really focusing on earnings. We're in the midst of another earnings season. Last week was big with a lot of the mega cap FANG stocks reporting, Microsoft and Amazon and Apple and all of those. No shortage of earnings this week as well. And I wanted to hit on a couple of the themes that I'm seeing. As we mentioned earlier in the week, a cluster of companies reporting, some energy names. We'll hit on a couple of those. Some travel tourism names like Marriott, like Airbnb, healthcare stocks like Moderna, Regeneron, Gilead, and also random things, some retail like Starbucks and others. So let's get through some of these charts together and see what we can learn about what the market's been telling us. MRO, Marathon Oil, is actually today after the close. I was going to say, I think it was today. Yep. And MPC was yesterday, sort of a related name. So, you know, MRO, the challenge with all of the energy stocks is oil prices, right? And weaker oil prices. Look at the chart of crude oil. Look at the chart of the DBC, or one of the broader commodity ETFs. You're seeing them rotate lower. All of the energy names struggling for the most part today. There's MRO down about 4%. DVN and FANG were earlier in the week. That's Devon Energy down 6.5% today. Here's Diamondback down about 5%. So the one-day movements don't concern me as much as the overall trend. And when I'm looking at the chart of DVN, and again, I would encourage you to take a few steps back from the monitor or the TV, wherever you're watching us, and just look at the larger trend. It's easy to get caught up in today's move, but take a step back and look what's happened. We spent a lot of time on DVN over the last couple of years above an upward sloping 50-day moving average. That is kind of the classic, everything's good, up and to the right, long and strong, beautiful chart is DVN, like January of 2022, right? Making new highs above two upward sloping moving averages. That's a big thumbs up. And you can see a number of pullbacks to the 50-day, all could have been bought, right? All were great Bible dips with the next leg higher. That changed in June, coming off of another new all-time high. We finally fail at the 50-day moving average and get down to the 200-day. That's the first time we touched the 200-day since November of 2020. Talk about just an incredibly consistent, powerful run to the upside. Now we've bounced off the 200-day and have hit the 50-day from below, and now we're failing to break above a downward sloping 50-day moving average. It's kind of like this brilliant run, but flipped over. That is not a good look, right? When stocks rally to a descending 50-day moving average and pull back there, when the RSI gets right up to 60 and then fails, that is more characteristic of bear market phases. So while I think there's still more to happen to turn this into a negative chart, I think a break below 50 and making a new low, getting below the 200-day moving average, which did not happen in early July, I think that would be the most damning piece of evidence that we could see. But the fact that we've rallied and failed at the 50-day moving average is concerning to me. A lot of energy sort of fits into that same kind of bucket with charts that had been very, very good, coming off of new all-time highs a couple months ago, but now failing to mount any sort of meaningful advance. All down today, but I think it's more about that, how today fits into the bigger picture, which is concerning for me. You know, with some healthcare names, some interesting bounces there with biotech today. Gilead is up 4.6%. You'd like to see a chart like this get above the 200-day moving average, get above this resistance range. Right now, it's rallying into resistance. Gilead really hasn't gone anywhere since February, right? You had that sell-off from the high in December. From there, it's really more sideways, right? Sort of range-bound around that time. We're waiting to see which way things break. You know, bouncing higher today is certainly encouraging, but I would want to see it get above resistance. That's what we've not quite seen on some of those names. Moderna, one of the biggest gainers in the S&P, might have been the top gainer in the S&P today, up 16%. They reported before the open today. That is an impressive run. And what I like about this is getting above 175. That was the resistance from late January. That was the resistance in March, resistance in July. And look at how we've broken above that basing pattern. Take a simple measurement of the height of this base, which is around 120 up to 175. You assume a similar move to what we saw there. That's about 55 points. That puts us to 230. That would get us up to right about there if we would basically take the height of that base and do a similar move to the upside. That's impressive. Getting above the 200-day would be important there as well. Also just to hit, because we only have a minute left or so, looking at Lucid Group, this automotives group has been interesting. Lucid really has been struggling to get above resistance. That's what's, I think, holding back some of the bullish sentiment that we could be feeling, is the fact that some of these charts, given the opportunity to break to new highs and hold them, have not been able to do it. Lucid holding above 220 would be pretty meaningful there. Tesla obviously in the same group, getting above the 200-day moving average this week. Can it hold that? That would be the big question. What encourages me about this market, or what makes me feel less and less comfortable with my bear market rally thesis, are charts like Tesla. Tesla, basically broke out of resistance, this consolidation range, pulled back, and then resolved to the upside, now testing the 200-day moving average. Apple has already done that, but has followed through. And it is hard to remain bearish when you see Apple do this, right? When you see Apple breaking to new swing highs and getting above moving average resistance. I totally get it. This is why we focus on key lines in the sand. This is why the S&P 4200 is such an important level. I am focusing on the fact that Apple is now overbought. That is when the March rally stalled out, when it got to right around 70. That's when we got toward the end of the move in November and December of last year. That's the question mark on charts like Apple that have already had pretty good runs. But boy, the evidence is what to focus on, as my guest today, Louis Llanes, said. The evidence right now is certainly leaning bullish on Apple. We need to wrap the show. Boy, these shows go by so quickly, but we need to wrap it up. We need to go to the 3 and 3. Let's talk about 3 charts in 3 minutes. Here we go. Chart number 1, the Bullish percent index. Louis Llanes, my guest, was making serious fun of me before we went live for how many colors and lines I have on this chart. I apologize profusely to him, and I will do the same to you. My point of doing this is to just show how we have a couple different scenarios. A couple different things have happened with the Bullish percent index since the 2020 market low. We had these during the bull market phase. We had brief pullbacks below a 50% level. Those were very buyable dips, and that's what we saw sort of at the end of 2021. But all of a sudden, the indicators started to look a little different. We had sustained moves below the 50% level. Those ended up being brief bounces before another leg lower. Then we have had extreme moves below 30% or the 30% level. Those have been really signs of a beaten down bear market phase and continued downtrend. Now, all of a sudden, we're seeing an observation very similar to previous bear market rallies, which was late March, early January, and even mid-November of last year. This is when the indicator had been below 50% and then goes above 70%. This is what concerns me about this market, the breadth conditions that line up very similar to previous bear market rallies. We could change that by having these indicators remain strong and not pull back from this current level. Chart number 2 is the retail ETF XRT. My conversation last week with Ms. Schneider was a lot of fun. That is on StockChartsTV.com or on-demand platform. If you missed it, I would encourage you to check that out, because we talked about retail. Her comment was less focusing on the FANG stocks, or what I call the phenomena stocks, and more about retail, right? Do you have the participation in traditional retail stocks? The XRT is a great way to reflect that. Currently at the upper end of the range, I'd like to see the XRT get above 6750. That would take it above the June highs. The S&P gets above 4200. The XRT gets above 6750. It would be very, very difficult to remain bearish in this environment, given that strength. Finally, PayPal, yet another earnings release this week among many. In our segment, The Bottom Line, we hit on a number of names that are reporting earnings. I'd encourage you to use our simple summary page to look at some of the stocks that are reporting earnings, to keep on top of those after-hour movements, but more importantly, what the market does in the session after their earnings release. PayPal gapping higher, trading lower through the course of the day. And I think it's important to note it's right at $100 a share, which is a big round number. If you look back through a lot of stocks through history, they often find support or resistance at $100 a share. We have now gapped up to that point. My question is, what happens tomorrow through the rest of the week? Can we hold 100? If we pull back, can we hold 90? That's the upper end of that gap. Folks, that's our show for today. Special thank you to Louis Llanes from Wealthnet Investments, joining us from Colorado. As always, providing some great thoughts for us. StockChartsTV.com is where we house all of our previous episodes and interviews. For Stock Charts in Redmond, Washington, I'm Dave Keller. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.